The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I'm going to switch shows around today. I felt that with some of the calls and some of the emails that we've gotten, I wanted to talk a little bit more specifically about something that's a phenomenon that's going on in the market. So I've invited back Kevin Lane to the program to talk about, sort of where we are in the market. And there's some interesting things that I hear, and I definitely want to, dispel some of the myths that are out there. And so I think today what we're going to talk about are, some of the top, let's call them the top 5 myths that we're going to debunk, that we're going to put to bed for you so that you can understand and work the markets a lot better. So without further ado, welcome back to the program, Kevin.
Thanks, Peter. Appreciate it.
Yeah, no problem. So it's an interesting conversation, but, I hear all the time that, when the markets are going great like they are, what do I need a stock picker, an advisor for, when all I have to do is just buy an index? And that question keeps coming up because it just seems, if that's the case, it's so much easier. I was reading a story this morning about robo-advisors and how they're, replacing humans in this whole market. But yet, at the same time, these same people, Kevin, are saying, oh, the market's at all-time highs. I'm starting to get nervous. So on one hand, they think they can do it themselves, and on the other hand, they think they need advice. What's your comment on that?
Well, I think it's an interesting, phenomena. I mean, it has been, one of the places really since the advent of the technology age. It's really introduced technology really quick and fast, faster than any other industry. And, so the idea of the whole robo-advisor thing is really just another extension of technology coming back to the marketplace. The one thing, we do like the idea of the analytics in terms of, what robo-advisors do, but, there's limitation in regards to, what you can do versus obviously what a human can do. And, it's deciphering the nuances, of markets and the psychology part that I think is hard, for a program or an algorithm to do solely. Like what we always like to say is, we like to use the analytics and the algorithms to make the best possible decisions we can make and be armed with the most amount of evidence. However, that only gets you 80% of the way there. The other 20% of the way there, and unfortunately, that's kind of where you get that differentiation, and you need the human element.
Yeah, and so you published an interesting article last week, and I'm just going to read an excerpt from it, and I'd like you to comment on it. But late last year, and in early 2014. There was a lot of talk of it being a stock picker's market. More favorable market conditions that the thinking held was going to make life easier for mutual fund managers, but that didn't happen. And in fact, it turns out that some of these mutual fund managers are woefully underperforming the index again this year. And I mean, what do you attribute that to?
Well, we always laugh, kind of. There's the two sides to the story. There's the side that, how do the professionals approach the market, and then be a sort of form, but sustain at the same time. And, unfortunately, for some of the larger media outlets, like CNBC and Bloomberg, they have to kind of produce content 24/7. And so this term stock pickers market, I don't know where it started, but it kind of cropped up. And, we kind of, always laugh at the term of this is a stock pickers market. And, in one aspect we laugh because, well, isn't it always a stock pickers market? I mean, if you're buying stocks, then it's kind of always a stock pickers market. But the idea came up that people had always said, well, when a lot of stocks and ETFs are, highly correlated, meaning they're all kind of, moving in the same direction at once, then you could pretty much just about, wouldn't matter what you bought because everything was kind of moving in tandem, in concert, if you will. But quote unquote, in a stock pickers market, these correlations were unwinding, meaning that stocks and other instruments and ETFs and various things weren't moving in concert, and there was actually some differentiation amongst that. And in that kind of environment, stock pickers should thrive when assets aren't lowly correlated, because then the idea is you're supposedly relying on their skill as a stock picker in a low correlated environment. However, there was a research piece done by Ned Davis Research recently, and they kind of sort of blew that theory out of the water, and they talked about it's not necessarily the correlation and how closely correlated things are that would, quote unquote, determine whether you are in a stock picker's market, but more importantly, they use the term dispersion. How many stocks within, and for instance, let's just say the S&P 500, how many stocks within that 500-member universe are actually outperforming the overall index itself? And what they found is actually money managers perform better when more stocks are outperforming the average. And of course, that, if you think about it from a common sense perspective, that makes a lot of sense. I mean, if more stocks within the S&P 500 are doing a lot better than the overall index itself, that means a lot of stocks are doing, much better. And if a lot of stocks are doing much better, well, of course, it's going to be easier to find a stock that's doing really well.
Right. I mean, they basically have a better chance of picking a winner.
Right, of course. And so the idea is, that, and I think what we've recognized, and there's that theory, the rising tide lifts all boats, of that saying. And I think that's really what this means, is you have a better chance of being a successful stock picker if more stocks are going up. Well, that's, kind of understood. I mean, obviously, if more stocks are doing better, then the chance of you hitting on a good one is good. So the idea that, this thing that there's a stock picker's market, what it suggests, and how we're debunking this, I guess, is, that a stock picker is only as good as the conditions of the market.
Yeah, and I think that's the interesting point. And so you mentioned dispersion. Can you get, I guess what is confusing to me about that term is that you're watching some stocks beating an index. So how can an individual stock beat the index for which it's in? I mean, is the index, it just takes an average of all the stocks? I mean, how would that work?
Right, correct. Yeah, the index, of course, would average all 500 stocks. So, if 60% of the index members are beating the index by, some percentage, 3 or 5% on average, 6%, 10%. So 60% of the index members are, beating the average by a decent margin. Then, of course, you're going to have, that means the other 40 aren't, and that drags the overall total back. But again, it's kind of like the theory of traveling in a pack. A pack is much stronger, than a lone wolf, if you will. And so when more stocks are doing better within an index, that just means the overall market environment is better. But it kind of debunks that idea that there's these incredible stock pickers out there. Now, that doesn't mean you can't buy the top stock in the index that maybe outpaces its peers by 30 or 40 or 50%. And that's how maybe some people get labeled better stock pickers than others. But the idea is generally when the overall market is doing better and more stocks are doing better than the index, that's a favorable market environment. It's a market environment that kind of, I don't want to use the analogy of throwing a dart, but you have a higher probability of picking a successful stock, when more stocks are participating. So this idea that, stock pickers are great stock pickers are only as good as the market environment. Show me how many guys had really good stock picks if they were picking along during the '08 crisis or after the internet bubble, in a market where things were falling. So you're only as good as the direction of the market, but then you can bet on, the faster horses, if you will, and that's how you can outperform.
And is it also reasonable to assume that, people that follow the markets like yourself or a research firm like Ned Davis, they're going to understand better when a market could potentially turn other than a static index?
Of course. I mean, while there's, no holy grail, as we always like to say, or no exact science, what you are looking at is you try to put together as much evidence as possible to help you really weight your portfolio, meaning more long, more cash, more short, more stocks, more bonds. And what you try to do is, I always use this analogy of it's like a doctor assessing a patient. Somebody that's very sick may walk into a doctor's office and visually, before the doctor starts running any diagnostic tests, he looks at the individual and he thinks, wow, this guy looks like a normal, healthy, person, what have you. Then all of a sudden, they take some blood work and some of the blood levels are abnormal, or there's, higher white counts, which could suggest infection or what have you. Then they take an x-ray and they see something they don't like, and all of a sudden, what appears to be, look good on the surface, underneath the surface, there's been a lot of deterioration, and that's really one of the things I think we try to sort of rest our sort of reputation on, is trying to find these deteriorations under the surface of the market, because typically, if you look historically at any market top or bottom, there usually are some telltale signs of subtle improvement or subtle deterioration long before the market actually falls apart on a top or rallies off a bottom. So it's kind of trying to, get under the surface and look at this unbiased data, to say, hey, 0.1 is positive, 0.2 is positive, 0.3 is positive, 0.4 is negative, 0.5 is positive. And you look at all these factors and all of a sudden you say, well, 9 out of 10 factors are positive. Does that mean you're guaranteed to be right? Of course not. But it does suggest you have a better shot at being right, when 9 of the, potential indicators or measures you're looking at are positive, than if only 5 of them are.
And that's interesting, Kev. We're going to take a quick break. When we get back, we're going to continue this conversation of some of the myths in the market and really when to hire a stock picker versus an ETF. You're listening to the In Black and Weitz radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to this program. You're listening to the In Black and Weitz radio show. I'm your host, Peter Weitz. Please feel free to email us any of your questions at peter@inblackandweitz.com, or you can follow me at Twitter at Peter Weitz is my handle, or LinkedIn at In Black and Weitz. We're joined today by market expert Kevin Lane, and we were talking about the differences and the nuances in the market between when to hire an expert professional stock picker versus just buying an ETF like the S&P 500. And sort of analogous to that, Kevin and I were talking yesterday about this great sub shop or this great meatball sub that's available in the Boston area at a restaurant called Brigo. And the thing about it is if you were going to pick a meatball sub, how do you know what to pick? Well, if I'm going to a big city and I'm looking for something to eat, and I'll use my meatball sub analogy, I'm probably going to go to the food critic first and ask the food critic, or read an article the food critic wrote about a particular restaurant or a particular food, and I'm going to use that as the basis for where I begin my search. I might even go to the concierge of a hotel, but I'm probably not going to scout out a bunch of different restaurants at random to find which one I think is worthy of my taste buds and a meatball sub. And so analogous to that is, Kevin, and correct me if I'm wrong, is I think the purpose of hiring an expert is that they're going to do the research for you. And I just wanted your comment on that.
Well, I think that, that's really kind of the case. I mean, you want to, when we talked about this before in one of the other programs, that, people will spend an inordinate amount of time researching, various things like a washing machine or, what another appliance, or buying a car. But then they'll throw 100,000, 200,000, 300,000, whatever the number, into the stock market and read like 2 minutes of an article and say they want to buy the stock. And, clearly it's a recipe for disaster that, you have to be prepared, in anything you do. And again, what separates, I think, people from being successful in any industry, is really that preparation and being able to, like you said, to do your homework. You're not just going to walk down, Hanover Street in the north end of Boston, and because there's a guy outside the restaurant saying, "Hey, come in," you're going to come in. You're going to have consulted Zagat's. You're going to have talked to the concierge. You're going to have gone to Yelp. Maybe you're going to have gone to 6 or 7 different places, and maybe and aggregate all of that information and say, "Hey, not that I couldn't walk in and have a horrible meatball sub, but by the same token, the chances are pretty good going to 6 or 7 distinct data sources that are all independent of each other, and they're all saying, it's good." And I think that's kind of the way approach things is I know we both like to use analogies, so I always talk about, being able to come into the water when we were kids at the beach, and when we used to go to Maine, on the bathhouse there was always a flag, and the red meant it wasn't safe to go on because there was a strong rip current or an undertow. Green flag, meant that it was safe to go in the water. Yellow flag was kind of, an in-between, almost analogous to, a red light, yellow light, green light scenario. Okay, red light, stay out of the way of the market right now. Yellow light, maybe you have reduced exposure where you're hoarding some cash, but there's still some opportunities that are out there that look good. And then a green light sort of being all in, invested. And that same scenario applies, is that you really have to do as much homework as possible and, make the best educated guess you can. And that's really how we try to attack the market.
Yeah, and that's so let me ask you this question. And, a lot of people have a strategy where they just say, all right, now I'm going to buy a mutual fund. And I'm just going to go to Morningstar and I'm going to see what's 5-star rated. And I'm just going to pick the best rated mutual fund that's out there. And I know that you feel that sometimes buying top performing funds could be a good investment strategy as long as you're not chasing performance. So is that a good theory, just to pick whatever Morningstar rates is the best?
Well, I think there's several answers to that. The first answer would be that and they've done studies and countless studies on these kind of things, that the stocks or the mutual funds that have done the best over a 3 and 5 year period tend to not do nearly as well over the following 3 and 5 year period. And, a lot of that can be attributed to several things. Some of it could be markets typically, bull markets typically kind of fall into that 3 to 5 year cycle, that you'll have a 3 to 5 year cycle of an up market, and then all of a sudden you'll have a fall off. So, of course, if you're buying, a top performing fund that's been outperforming for the last 3 to 5 years, it's hard for that fund. Maybe it's the holdings they own. Maybe they're not changing their portfolio enough. Maybe the original portfolio they had over that prior 3 to 5 years just happened to be the right mix of stocks to own at that time in the market. Maybe they were heavy in technology and technology was doing well. Maybe they had biotech. And maybe over that 3 to 5 year period, that sort of success breeds a little overconfidence that, hey, I'm going to stick with these stocks because they've done so well and I think they can do better. And all of a sudden, maybe there's a shift in the market. Maybe biotech and healthcare and technology go out of favor and energy comes in play or something else. And if they're not constantly rotating their portfolio, and as another analogy, like we always used to say, one of the things that they said that made Wayne Gretzky so great was he always skated to where the puck was going to be. He could anticipate. And a lot of times money managers, particularly at the mutual fund level, they're not agile enough. They can catch a cycle right, but over the long haul, they don't know when to shift into different asset classes or different market sectors and things of that nature. And chasing performance is one of the worst things people can do, I think. And to your reference of the Morningstar ratings, I haven't done a lot of, detailed analysis of that. Obviously, they have a rating system, but I don't know if you've always bought the 5-star funds versus the 3-star funds. What the differential in performance is over a great period of time is. But I think selecting a mutual fund, going back to our original conversation about dispersion and what kind of market is, if you're in a market that's not doing well, it probably doesn't matter what fund you're in, because realistically we know the history is that something like 90% of all fund managers underperform, the S&P 500. So I have very strong belief that the fund you're invested in, when you're invested, is almost as important. When you're invested in the market is almost as important as what you're invested in or who you're invested with.
Well, and I think that's the interesting point. I mean, if you just buy a mutual fund, I mean, the Ron Popeil set it and forget it strategy just doesn't work. I mean, you've got to know when to get out.
Right. I think nowadays, given information moves so quickly. Years ago, the arc of getting information from super sophisticated investors figuring things out that things were getting bad or getting better to it trickling down to the masses was a very long arc. But now with the internet and the speed of information, we get these time compression cycles that things that maybe took a year to unfold, can happen in, weeks and months. And so you have to be prepared to be tactical. And like we always say, you can't be reactive. You have to be proactive.
Yeah, and that's it. So let's talk about a couple of sectors. And, I want to get your opinion on whether or not in those particular sectors it's time to consider hiring a stock picker, or is it something you can do on your own? And the first sector I want to talk about is financials.
Sure.
Obviously the banks have been browbeaten over the years. I don't think they've recovered yet since 2008. But is that just let me buy a financial ETF and I can let it run?
No, I think it all depends on your own investment belief. I do believe, with quantitative rankings and technicals and different fundamentals, I believe in a good market that if you could select the best bank stocks and create your own basket, you can do better than an ETF. So it all depends, I guess, on investors' belief. Now, the flip side of that is, of course, the ETF is going to be generally cheaper, but and that could lead us into another discussion about diversification and things like that. I've always been a firm believer that you want to have your best athletes on the floor. You want to have you want to pick the fastest horses, and rather than buying everything where you're going to get some of the bank stocks that are doing really well in an ETF, but you're also going to get the laggards, and that's going to really mute your performance. Me personally, I always feel like it's better to try to find, the best of the best and buy those.
Yeah, and I think that I agree with you there. I mean, that's certainly fun. We're going to talk about a couple of other sectors when we get back from the break, and we'll be back in just a moment. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I am your host, Peter Weitz. I'm joined today by Kevin Lane, and we were kind of discussing some of the myths that are going on in the market. And I actually want to just make an aside as to our conversation today. But we were talking about at the break, and Kevin, the other day I was on one of the e-commerce websites. I don't remember which one, and I had three methods by which to pay. I could either pay with my debit card, I could pay through PayPal, or I could use Bitcoin. And I don't really understand Bitcoin, and I want to get your opinion on what you really think it is or isn't. So,
it's interesting. I mean, conceptually, the idea of a digital currency, sort of, in a digital age we live in, conceptually makes a lot of sense, but it seems to be a very murky sort of market with pretty much virtually, not a lot of regulation. And I remember, back a while ago, we had written a piece on the blog around the same time that the Winklevoss twins, or as they're referred to in the media, the Winklevi, the two original supposed founders of Facebook that Mark Zuckerberg stole the company from. The Winklevi were on CNBC, and they were touting Bitcoin. I guess they were early adopters and into the strategy, what have you. I remember looking at it. So my natural reaction was to look at a chart. So I look at the chart, which had gone $1, like the year $1,600. So one Bitcoin was equal to $1,600. And I remember looking at that. I said, geez, if I was a mill, that thing was basically almost vertical. There's no way I could sustain that pace of acceleration. And I combined it with the idea that, the Winklevi were on CNBC, and that kind of, from a sentiment perspective, seemed very bubulous to me. And I had written this piece that, you could, I would probably be short Bitcoin at that point. I had like $600 within like a week or two. It's a very interesting space because there's a lot of smart people that are putting money into it. Now, granted, I've seen recently, some billionaires and people that run private equity funds and things that are investing in it. But at the same time, they're worth $1 billion and they're putting, $3 million into it. So it's not like, they're putting hundreds of millions into it. So there's definitely some interest. I think people want to have a stake in it. And I don't understand the nuances of it 100%, but I know there's, machines and they print these Bitcoin and, you can accumulate them. But whenever there's this sort of excitement and speculation in a new industry, I always take the idea that it's better to wait for the industry to develop, have its traps and pitfalls, and kind of get into it when it's more mature and established. I don't know if you remember, Peter, everybody was calling us in our industry back when we, invaded Iraq and different things about buying Iraqi dinar, the currency. And so there's always speculation around those kind of things. And I think in the early stages, it makes more sense to either say, if you're going to do that kind of investing or speculate, it should be with a very, very small amount of your investable capital and something you could be willing to literally burn and watch go to zero. Me personally, I'd rather take that money instead of buying Bitcoin, because I feel it's, not really that legitimate at this point, that I'd rather do something more tangible with that money than just, play at the Bitcoin slot machine.
Right, because, at the end of the day, you could be left holding the bag. It might be worthless.
Right. And we always talk about this, too. I always talk with clients about cost basis. It's easier now when you get a little market volatility and the market's coming down a little or whatever to say, if somebody bought stocks in 2012, 2011, 2010, and their cost basis on some of these stocks are $40, $50, $60 lower, then I can say to them, look, well, market's still in a bull market, still an uptrend. I know yesterday may have been a loss, but let's be a little more patient because you have the luxury to be patient because your cost basis is cheaper. So if somebody came and put money, to work in the market last week, last month, and the market started selling off aggressively, that's a different picture, and if you're starting at elevated levels, there's as we always used to say in the business, in the chart, there's a lot of air beneath you. And so it all depends on your cost basis. If I got in, and speculated on Bitcoin when it was $50 or $100, and went to 1,600, then it went down to 1,100 or 600 or whatever, and then back up to 800. Maybe I'd sit with some of it. But if I was walking in today and somebody said, "Should I buy Bitcoin?" My first response would be, "Well, if you're prepared that you could potentially lose every dollar you put into it, go ahead."
Right, and it's even more amazing because I don't know how you can start, how quote a person can start a currency. It just makes no sense that somebody could actually own a currency. But thank you for that. So let me ask you this question. What sector do you think right now is the best stock picker sector that's out there, or one of the best, and why?
Well, if you go back over time, there's different cycles of a bull market, and later cycle plays tend to favor energy. And I know not too long ago we had bought in Schlumberger and a couple different energy names, and energy tends to be a late cycle move, meaning when you're towards the end of a bull market, whereas like financials, technology, things like that, biotech tend to be early cycle moves. And so when I say late cycle moves, it doesn't mean like tomorrow. I mean, late cycles could last 8 months, a year, 12 months. But typically when energy starts to lead, it tends to be sort of the last sector that has its day in the sun. And if you look at all the energy stocks, it's not just one or two stocks, making new highs and seeing money flow into it. It's, one after another, after another, after another. In fact, that idea that we talked about, dispersion, there's a high number of stocks in the energy sector outperforming, the benchmark index. So to answer your question, I would definitely look in the energy sector for stocks where I think there could be outperformance.
Right, and is it because those stocks are still lagging behind and there's still room to grow?
Yeah, I think part of it is, they lag the market for a while, and of course money tends to look to sectors and says, okay, what hasn't moved yet? Let me kind of get in there. It's also, I think, because of, longer term factors we're starting to see with, the energy shales and sort of this, idea of increased U.S. production and things of that nature. So I think there's a variety of reasons why that's occurring.
Yeah, and what about biotech?
We've been on the record for a while, and something we've written on in research publications and on the blog. And that same analogy of getting on the treadmill, with the exception of some of the incredible stocks that are just executing and have incredible cash flow and things like Gilead and things like that, the biotech sector had gotten, in our opinion, really speculative. In fact, over probably the last 3 to 6 months, the two, sectors that have been underperforming the most would be biotech and small cap stocks. And both of those tend to underperform when money managers, by and large, are trying to reduce some risk. The biotechs, have gone up precipitously over the last 3, 4, 5 years, and they've gotten to a point where they were almost pricing in some perfection. And I think you saw a lot of people saying, hey, maybe it's time now, this idea of mean reversion. If you stretch an elastic band, too far in one direction, it's going to come back towards the mean. I think a lot of people said, hey, biotech is so far ahead of everybody else in terms of other sectors, other markets in terms of performance. Let me take my money, rotate out of biotech, and maybe I'll rotate into healthcare or utilities and some other sectors, lock in those profits, but also reduce, some of the risk of my portfolio, because those sectors not only tend to move more on the upside when the market moves, but they move, typically more on the downside when the market comes down. So I think you're seeing some of this rotation away from small caps to large caps and away from riskier sectors to less riskier sectors of the market.
Yeah, and I hear with regards to, every time I mention to someone healthcare, one of the comments they make to me is, oh, but doesn't Obamacare have to, isn't that going to squash all the healthcare stocks? And, there's a big difference between research and development and cutting a physician's amount of billable hours.
Yeah, I think there, you hit that right on the head. I mean, there's obviously, very diverse sectors within healthcare. There's healthcare equipment, there's HMOs and providers, and there's hospitals and what have you. And I think that, Lisa Miller on the program before, who's our healthcare analyst and is an expert in the field. And so I wouldn't want to, overstate some of the things she said, but I think, what you're seeing is fragmentation within the healthcare sector, that there's certain areas that are affected by healthcare legislation more than others. But yet, by and large, overall, most of them have done pretty well, even the HMOs.
And that's interesting. We're going to take a quick break, and when we get back, I just got an email that came in, and we're going to talk about that in just a moment. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Right before the break, we got an email from a listener, and Kevin, I just want to have him. I'm going to read the email to you, answer the question, and then
Sure.
we're going to get a little bit into diversification because I think that's really important. But listener Gordon Shumway says, Gordon writes, how do you hedge for second half of the year in equities? The first half was pretty volatile, and does volatility precede lower prices in the second half of the year?
Interesting. We always use the term that, for us anyways, volatility arises when there's indecision. And what I mean by that is, when in aggregate, all these portfolio managers and different people that control large pools of money, when they're decisive and there's a clear path that they can sort of see earnings are going to be X, the Fed is keeping monetary policy stable and accommodative and, all these different factors, it just get in and sit back and ride them. When people start one by one, and it doesn't happen, all together, but little by little, certain portfolio managers may say, well, I think the Fed is going to, pull back on QE. I think profit margins have maybe peaked out. Another quantitative manager who runs some studies may come to the fact that, maybe a certain percentage of the stocks now are underperforming the index that typically in the past has suggested a weaker market. And one by one, they start to sort of sell stocks, raise cash. That creates, the down days. That creates the spikes in volatility. To this point, we have not seen any real, volatility at this point. I mean, the VIX, the measure of volatility is low. We haven't seen any what we would call abnormal sell-offs. I mean, most of the sell-offs have been, 1.5%, under 1%. There haven't been any of these aggressive days where it looks like a stampede out of the market. So at this point, volatility hasn't been an issue. When volatility starts to rise, I guess there's two ways you can go to hedge that. If you're holding individual stocks that you like for the long run and you don't want to create a taxable event, you can go out several months, what you may feel is the duration of the correction, 3 to 6 months, and you can buy individual puts. So at least if the stock is falling in value, your put option is rising in equivalent value, to offset the loss, and you haven't created a taxable event. If the other option is you could just raise cash and, get out of the way. So for maybe people that are in an IRA vehicle, that don't have the tax implications, that they just wanted to say, hey, look, I was up 35, 40% last year, market's starting to sell off, volatility's rising. They could just go to cash and there's really no repercussions for that. The third way, of course, is you could do a combination of those things. You could buy an inverse ETF, which, is betting that the S&P or some index like the Russell is going to move lower in price. And at this point, if I had to pick a market to do that, to hedge, I would probably be the Russell because small caps have been the weaker of the various indices. But realistically, you could buy some puts on some individual positions. You could buy an inverse ETF on the market with a certain percentage of your portfolio, 10, 15%, 20%, whatever you felt was the adequate amount of protection you needed, and also raise some cash. So there's a variety of ways, you could hedge out a potential downside risk, should that occur.
And, I guess about a week or two ago, you actually put a short on in your portfolio and your long short strategy to hedge against the market. What was your thinking then?
Sure. So we had come off a very good 2013, as you know, and 2014 had been a little more challenging. There was the correction in the spring, and subsequently, we kind of rebounded from that correction and kind of got ourselves back in line with what the general markets were returning, 6 or 7%. Of course, I speak right now of unaudited returns at this point. And as the market started to kind of have some geopolitical dislocations last week in the Ukraine and things of that nature, and knowing we had a really good last 30 or 40 days, that we were susceptible to a drawdown. And look, we know at any point in time the market could have a correction just based on the preceding run-up, which has been very spectacular. So we bought some individual hedges using ETFs on the Russell 2000, the small cap index, and we also bought volatility has been low for a long, long time, so we bought the VXX, which rises as volatility rises, and we also bought the inverse S&P. And one of the interesting things, and this is what we talk about being tactical. When you be tactical, you make a tactical move. Sometimes they don't always turn out right. And right now, a week later, we always use this saying that it's not the news that matters, it's how the market reacts to the news. On the news of sort of this thing going on in the Ukraine and other things, the market had a one-day sell-off, and it subsequently has reversed all of that sell-off, and it was as if it was a non-event. And then what that tells me is that large pools of money managers analyzed the event very quickly and said it's not much in the way of a major skirmish enough to dislocate global growth, so therefore we view it as a non-event at this point. That said, we now have a small portion of the portfolio, maybe 15% that's moving against us. Now we still, maintain quite a bit of long exposure. So in the next day or two, we'll decide that if the market doesn't cooperate and turn down, then we won't fight that trade. We won't be stubborn. There's an old saying, and these trader axioms, as we like to call them, and one of them says, it's okay to be wrong. You just can't stay wrong. And so our thinking was that if we had a correction, we wanted to hedge out some of that downside risk. And now it turns out that maybe we won't get it. We'll take that, small drawdown on those, 3 or 4 positions that represent a small portion of the portfolio, and we'll just, put that back into cash and then determine if we want to reestablish that on the long side or not. And it's kind of an ongoing process. Every day can bring different events. Every month, you get new data points that come out. And it's not managing money is not, as you put it, sort of this buy and hold exercise where you go to sleep. It's an ongoing process because the market isn't static. The market's dynamic. It changes. New information presents itself that can lean you to be more bullish or more bearish. And so in that regard, we felt like there was the potential to have some protection. And, in the coming days, if we determine we're wrong in that trade, we'll just unwind it, take our loss, and reassess.
Yeah, and I'm glad you brought that up because, again, I think having experts that know, here we'll use another analogy, the Kenny Rogers song, know when to hold them and know when to fold them, is critical. I mean, I think you need to know when to get in and get out. And I don't think that the average investor, it's not that they don't have the capacity, but they just don't have the time to do the research to know how to handle the markets because they're busy doing something else, and that's why they hire expert stock pickers like yourself.
It's funny. I have a friend of mine, and he's a very astute investor, and he said the difference between a pro and an amateur is the pros panic first, and I think that's true to some degree. And look, when a correction starts, you get the preconditions of a correction. It could be there's more new lows on a regular basis than new highs. There could be more stocks declining than advancers. The slope, of the market's ascent could start to flatten. The rate of change of corporate earnings, could start to abate. The number of stocks within the S&P that are producing upside earnings surprises this quarter versus last quarter may see a market drop-off. You will get these sort of signs. Now, they don't always necessarily lead to a correction, but we've seen them enough in the past that when a lot of these events line up, it's better to be cautious because I always say every big correction starts as a small one. So you can't dismiss any corrective activity.
And that's amazing. And Kevin, thanks again for being on the program. As always, it's interesting. I just tweeted that comment. The difference between a pro And a novice stock picker is that the pro panics first. And I think that speaks volumes to what we talked about today. But Kevin, thanks again for being on the program. And I can't wait to have you back on again, probably later into the year as we see what goes on in the end of the summer and the beginning of the fall.
Appreciate it, Peter.
Yeah, no problem. And tune in next week. We've got a great guest, and I'll be announcing it on the blog shortly. It's been a great week. You're listening to the In Black and Weitz radio program on Voice America Business.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.